All right, folks, welcome back. This is episode 6 in our ongoing ICT Mentorship on YouTube for 2022. And the market efficiency paradigm and institutional order flow will be our topic for this evening. All right, so how do we internalize price delivery? First, we do not trade patterns for pattern's sake. We do not trade indicator readings or momentum. We look to enter longs where retail sells. We look to enter shorts where retail buys. We anticipate price seeking opposing liquidity. Okay, so what does that mean? Well, if you're looking at this diagram, imagine if we could take price as a conceptual idea. It doesn't matter what market it is, but let's just say there's two camps. There's the informed or smart money, and that's represented by this small little circle over here. And then there's a larger collective, which is the speculative uninformed money. There's a large influx all the time of new uninformed money coming in because there's a large influx of uninformed money going out because they lose their account, they blow up whatever equity they have in their trading account, it's gone because of lack of discipline and a flawed logic. Smart money traders, when they look at the marketplace, they're not looking at secret trading indicators. What they're specifically looking at is time and price. The most important thing is time, because time, that is the most crucial element. So time of day is vital when we're engaging price. For a professional, through the lens of smart money, time is crucial because time of day, there's specific elements in a daily range that really build the likelihood of volatility to come in. And also when short-term reversals are likely to occur. Okay, so I mentioned in previous lessons that there's algorithms that will start to gyrate and cause price to run at specific times of the day. Smart money looks to cannibalize this group of trader. So because they're typically wrong in their directional bias, in their stop placement, should they choose to use one, because a lot of traders don't use a stop loss as a retail trader because they're afraid, they may expect the market to go lower. And they understand that the highs above where they're at, if they're in a very small window of profitability, unrealized profit, that means they're still in the trade, but they don't have a stop loss in. Now, logic dictates that they should have a buy stop in to protect their position in case the market screams against them. At least it limits the amount of equity lost. But they may look at an old high and say, okay, I understand that my stop should be above that. But because of their infancy, they have no idea where to put it above that high. They don't want to put it too shallow because it might go up there and hit it and stop out their trade prematurely. Or they don't want to put it up too high and then it spikes through that and reaches for them, and then it reverses and goes in the direction they're holding. So they take a big loss and get stopped out. So those are the two conundrums that a retail trader falls into, that pitfall. But the smart money traders are not looking at price with, give me a pattern to trade off of, a bull flag, a wedge pattern, something to that effect. They're looking at liquidity. What is the underlying narrative right now in the marketplace? Is it bullish? Is it bearish? Is the day's daily range going to go higher? But how's it going to go higher? Is it likely to go lower at the beginning of the day first to sucker traders in going short, run out sell stops they can acquire long positions at, and then rally going into the close or maybe into the afternoon? And that would be the extent of their plan of action. And how does that speculative uninformed money and its liquidity that it provides, how can they utilize that? That's the market efficiency paradigm. It's efficient for smart money traders to view the marketplace in that perspective versus technical analysis. And you can lump me in there too, because the times where I'm trying to use the logic that I trade with, and if it fails, I've done something wrong. I've interpreted price wrong. Everybody's going to have a losing trade. Okay. So I want to give a little bit more specifics about the fair value gap. That way you have the rules, what it looks like, so that way you understand exactly what it is and where it forms, because this is going to repeat. So the bearish ICT fair value gap. This is institutional order flow, and it's a pattern that you can see the order flow actually coming into the marketplace. So we're looking at, what does a bearish ICT fair value gap look like? Well, if you take a look at this diagram, it's rather crude, I know, but you have a run preferably above some kind of old high. So the first candle is the high, and the next candle is the extended low that goes below it. And the third candle is another continuation candle, but the main important factors are this. It's a 3-candle formation. The first candle's low has to be traded below on the immediate following candle. The next candle has to trade with an extended low as well that went below candle number 2, but does not trade with a high that trades back to candle number 1's low. What that creates is this small little gap where one candle only traded from the range of the candle number 1's low to candle number 3's high. So that little space that's occupied right there, what is actually occurring there is price is only being offered on the sell side there. So imagine if you're painting your wall at your home, okay? and you take your roller, you put it in the paint, and you put the paint up against the wall, and you roll down, okay? At first, the first foot or so, there's going to be an ample amount of paint delivered to the wall from your paint roller. But then as you keep rolling down towards the floor, what will happen? You'll start seeing these little pockets that look really porous. What do you have to do to fix that? You just change directions and start rolling the paint roller back up, the same place you rolled down. That's exactly what price does. There's an algorithm that delivers efficient market delivery. So let's go back into that analogy with this. Between this candle's low and this candle's high, we only have sell side offers. So that's like taking the paint and applying it to the wall and drawing down with the roller. But now as you pull down, there's little pockets right in here between this candle's low and this candle's high where price has not been efficiently offered for buyers. Why? How's that working? Well, you have sell side being offered here because the market's delivering lower prices. It's offering continuously lower prices between this candle's low and this candle's high. To efficiently balance out that little inefficient area, at some future time, the market's going to want to trade back into that area. When it does, and you're bearish, that's a short signal. Okay, you can go short and sell there with the expectation it's going to start to move lower. Optimal formations of the bearish ICT fair value gap will be found after a run into buy side liquidity. So it's not a matter of going into charts and looking for this little gap all the time. This model I'm teaching you on this YouTube channel is meant for you to look for periods where price runs above an old high. Then it breaks down, and then you look for this pattern. This is what it looks like. The run above a single high or multiple highs, like a double top, okay? Either one of those fits this criteria. So what you're looking for is a pool of liquidity of buy stops. Resting above these highs, that's buy side liquidity. Smart money will want to trade up into that and go short. They may not be engaging above the high. They may miss it, just like any one of us that haven't been ready to take an order and place it in the marketplace. They may miss that. This is their saving grace right here, this pattern. That's what smart money's looking for. They're looking for that right there. And then once they see that, they go in either with their limit order, mark it in, something to that effect, and get short, and the stop would be above the high. That is exactly what you're looking for a fair value gap. So when you're doing your annotations on your charts, this is what you want to be doing. All your back testing, label the number 1 candle, the number 2 candle, is always going to be where the gap resides. And then the number 3 candle gives you the lower end. The upper end of the fair value gap is going to be the low of candle number 1. The lower end of the fair value gap is going to be the high of candle number 3. And the difference between candle number 1's low and candle number 3's high, that's the fair value gap. So the easiest entry would be trading just above candle number 3's high. You can put a limit order right there and be done. The bearish market structure shift. What does that look like conceptually? Well, you have the market trading higher, short-term little retracement, then it trades above an old high or the initial short-term high that it trades above here, and then it breaks down. Once that low is broken, that's when the new trade idea is now being birthed. You don't even know where you're getting in at yet until you go through this process I'm going to show you right now. The market will see a price delivery of a rally above an old high or highs and then quickly shift lower. That's this right here. Now the significance I'm placing on the term quick is linked directly to the term displacement. Okay, it's got to be energetic. It can't be a little lethargic little move. It's got to show a real willingness to want to go lower and preferably close below that. If it does that, that to me is a little bit more significant. Whereas if we just go through this low a little bit like a wick and come back up, that to me is not all that convincing. I want to see that it has absolutely displaced and then the candle closed, and then we look inside this range here. So when you're looking at market structure shifts, this is all time frames. So don't think this is just the intraday version of it, but I'm specifically dealing with intraday. So when we create that high down to the low that breaks the short-term low here, so now we have that shift in market structure there, right below that low. That is the displacement low. This is your displacement high. So what you have in between that range, that right there, you're going to be hunting your fair value gaps because that's exactly where it's going to form. That short-term low being broken, draw that out in time, that's your displacement low, and the high is your displacement high. So that range between here and here, that's displacement. How do you know it's displacement? How it closes down here below that low. So this is the secret to it here, knowing how we trade below that and if it's energetic, a lot of movement, a big beefy bearish candle that closes low below this level right there. Okay, if we have that, as soon as we have that candle form, start watching to see if it creates a fair value gap in between this low and this candle's high, or that range, okay? If there is no fair value gap in here, guess what? You don't have a trade. You wait or go to another market because one of them is going to be there. Everything I teach obviously is reversed the same way, so I'll just go through this a lot quicker because this is already becoming a longer video than I wanted it to be. But bullish ICT fair value gap, again, institutional order flow pattern, and it's 3 candles formation. The candle here is number 1, the second candle here, and the third candle there. Candle number 1's high that is the low of the fair value gap. Candle number 3's low is the high of the fair value gap. Candle number 2 is where the fair value gap will be formed. So that is your fair value gap, and everything you would expect to see in form of a market run below an old low or multiple lows for sell side liquidity. Once it starts trading higher and takes out a short-term high, that's not being shown here, okay, because I'm showing you the pattern itself. This is what you're looking for, okay, this separation between 3 candles. That's the criteria. You have to blend in the logic of a market structure shift that's bullish. So what does that look like? You have a market trade below an old low and maybe go another leg lower and create a run into sell stops. Once that occurs, then you're looking for a run higher that takes out a short-term high and it closes above it with an energetic displacement higher. Once you see that, then you have a trade idea being birthed. You don't have a trade entry yet until you determine if it has a fair value gap. Where does that reside? Between the displacement high and the displacement low. In between, right before the market structure is broken foolishly, and the low that ran into the sell stops, that is your range. This is exactly where you're looking for a fair value gap. So in that range, that's where your bullish fair value gap resides. If there isn't one there, you don't have a trade. All right, so let's go into the price action. So here we have the 15-minute time frame from today. This is the E-mini NASDAQ. Naked chart. Which swing high would you anchor? Where is there a stop run on buy stops? All right, so we have 8:30 marked here. Okay, very specific, right? Element of time, 8:30. Why? Because there's news that comes out, okay? Employment data came out today. So at 8:30, the market, from that point on here, look to the left. What do you see? What's the first swing high you come to? Right there. So this high here, draw that out in time, and you'll get this right here. But watch. With this run right there on a 15-minute time frame, what do you do with it? Well, you start stripping down from a top-down 5-minute, 4-minute, 3-minute, 2-minute, 1-minute. So once you have this level on your chart on a 15-minute time frame, you drop down to your 5. Everything's transposed from the 15 to the 5-minute. You can see it trades above it here, and the market starts to trade lower. When it's trading lower in here, you're going down into what? The 4-minute. Here we have it here. Is there a fair value gap in here yet? Nope. There's one right there. See that? Right there. So we traded below this swing low. There's a fair value gap right there. You can enter there, right on this candle's high. You can go short there. What's the rules? Do you remember what the rules were? You can put your stop above this here or the swing high. There's a swing high right there. I want to go down and really fine tune it. So I'm dropping down through all the time frames. 5, 4, 3, 2, 1. In the 2-minute chart, you don't have a fair value gap in here until there as well. Same entry. And you can put a stop there as well. And on the 1-minute chart, we have the run here. The break below the short-term low here, fair value gap, trade up into that. And look how many times it gives you a chance to get in. This candle, that's 1, 2, 3. Then it continues even lower. So you're getting a really, really tight entry there. I actually went in and traded this today on TradingView. And you'll see me entering right here and riding down and taking out my exits below an old low. But I'm going to also teach you how you can use the model here and use the exit strategy I used today for external range liquidity. So let's go over to TradingView. It started at the 8:30 hour. Our line here is at that 15-minute high. So what we're expecting is a run above that high. We're running above a short-term high right here. There's a fair value gap right there. Hit that. Now watch, it should sell off. That's not what I want. I want to use this high back here. But if you're a scalper, you could take that low out right there, and that would have been a trade there as well. But for the daily range, which is much more significant, I'm using the 15-minute high. I'm bearish on the day. I'm expecting lower prices because we've already went up a lot on the daily chart. So now, if you're waiting all day, you might look at this and say, oh, I missed it. There's nothing for me to do. Don't think like that, okay? Because the equity market opens at 9:30. Stock markets start getting really busy and volatile around that time frame. And we're coming up on it in a few minutes here. And usually, not always, but usually the first run at 9:30 is opposite to what the real move you want to be doing. Not every time. Now, here's a 9:30 volatility. Look how crazy it gets. Okay, it's creating a low with another low here. So there's what's building underneath that. Sell stops. Traders are being induced into thinking long trades. Go long, go buy and get in there and go high. Buy low, sell high, right? But it's sloppy in here. But it's keeping these lows over here intact. Above these highs, that's where my interest is, okay? So I don't have a trade until we get up above this level there. And this is on a 1-minute chart. Okay, small little shallow run. We want something that's going to push through it. No fair value got formed anyway. Okay, I just paused it right there. Now look at this initial poke above that high that we've drawn a line on. It went above it. It went down, yes. Did it create any fair value gaps in there? No, every candle overlaps. There's no gaps there, okay? There's also no swing low taken out. So there's nothing in here yet. Now we have a higher high running above this high and the high we were looking at on the 15-minute time frame, which is denoted by that horizontal line. Right there, now we have the likelihood. If we're watching it live, we're waiting to see, does it break lower? If it breaks lower, where is there a swing low? Right there. So if we can trade down below that swing low, and as soon as it does that, look in the highest high that forms and that low. See if there's a fair value gap that forms. Right there. We went below it after taking out the high. Here's your number 1 candle, the number 2 candle, and the number 3 candle. So there's your gap right in here. So if it trades back to this candle's high plus, I don't know, 1 handle or 1 tick, maybe 2 ticks, whatever you believe is an ideal entry for you. The easiest one is just go 1 tick above that and removes all the doubt. There's no guesswork there. There it is. And where's your stop loss going to be? Above the high of candle number 2. Or you can use above candle number 1, which creates a swing high. Okay, whichever one you can afford and allows you to put the trade on. Boom, right there. That candle, if you had a limit order right there, that would trip you in going short, and your stop would have to be above here. Another one right there. There's your second entry. Right above this candle here, that's entering. That's your limit order getting in. Go short. Same stop. Third opportunity. Almost completely closes in all that range right there. See that? Right there, if you see that live, it feels like it's going to keep going higher because this candle at one time, when it was at the high, was all green and bold. You need to trust and train yourself to look at this pattern as it's forming, because once you see dozens of it occurring, it changes your perspective. You don't get scared. In fact, it's fascinating to anticipate, okay, it went here, so now it's going to go lower. So at that point, right there at that entry, from this candle's low to this candle's high, where's about 50%? About right here, right? So before we go any further, where do we take our profits? Well, you have a fair value gap right there, right? So if you're selling short up here, you can buy it back below here because you're below 50% of the range that it range from high to low. You're at a discount down here. So there's your first target. Remember those equal lows down here I was telling you about? What's below that? Sell stops. So you want to be taking profits here and or here. This is ideal. Okay, let's go back and watch the rest of it. Right there. That's it. These are minute candles. So you're selling short here, or maybe you entered on the first one here. So that's minute 1. So 1 minute, 2 minute, 3 minute, 4 minute, 5 minute, 6 minute, 7, 8, 9, 10, 11 minutes. And you have 10, 20, 30, 40, 50, 60, we'll call it 60, we'll just call it 60. 60 handles in minutes, okay? If you are going to hold it, focusing below these lows down here, okay? Trust the bias. That type of move right there is intended to upset traders and get out. And if they trail their stop loss too short and aggressively, they get knocked out right before the big move comes down and takes out the lows down here. So we're looking at right in here. Well, let's look for 14,680. There it is. Now, Is that a lot of time getting short here, weathering some of this? You already took first partial down here. So even with this pulling back, your stop stays here. You use the first partial to kind of like quench that desire to roll your stop. Don't do that. If you do that, you're probably gonna get stopped out because you don't have the understanding or the experience to know where to place a protective stop while it's being trailed. Once it takes this low out down here, and if you want to hold onto a position, then you can roll your stop to here, but not before. Why? Because you've taken out a significant intermediate term low. This low to this high on a 1 minute chart, that's an intermediate term price swing. So it's taken out here, but it's also a full target for selling short up here and getting out down here. So now, in closing, I revisited the idea of this high to that low, that's your range, okay? And if you put a Fibonacci on that, so we have 50%, that's your equilibrium. So everything above that price level, because this low to that high, that's our price run, and 50% below it is discount. So there's your little fair value gap right there. You see that? That right there. That's your target going short there. But this is internal range liquidity because it's internal relative to this low and this high, that range. So it's in the middle of that range, which makes it internal range liquidity. What is the stops below these lows down here? External range liquidity. So partials, internal range, external range, close your trade. Very simple logic, isn't it?